we hear the word VC and PE, venture capital private equity, used very synonymously, and that is used as a term to cover all sorts of investors. The terms are fluid, but there are some parameters by which you can bucket these categories of investors. And I'm presenting this across the life cycle of a company. So as a company, starts off, and I'm going for my first round of external funding, I will typically tap into angel or seed investors. In terms of ticket size, these people can operate anywhere between 50 lakhs to, let's say, 3.5 crore, up to $500,000. And across multiple, different individuals. So you will go to a group of angels or a group of, investors, or it could be one institutional seed investor who can come in, one or multiple. So typically, these investors are high risk. They invest into opportunities where the proof of concept is not yet established, where the company may not even have started business, may not be generating revenues, and in a lot of cases could just be a business plan on paper. And these investors invest solely based on the promise they see in the management. So as companies mature, as you achieve proof of concept and start business and potentially start operations, you can tap into more institutional investors, which is where your venture capital investor comes in. So venture capital also is fairly high risk. Your VC funds will want to diversify this across multiple different investments. So your portfolio size could be anywhere from 15, 20 to even 30, 40, and 50 in a venture capital fund. And the portfolio is actually characterized by a high degree of mortality. So a lot of the companies where VC investors invest may not actually survive, may fold up, or may get merged with other companies. But there will be a small subsegment of companies, could be like 10%, 15%, which will be multi-baggers for the VC fund, which may net them 20x, 30x, 50x returns, and which may pretty much return the entire fund AUM itself in one. So that is the way a VC investor operates. They have tolerance for a high degree of risk, but they want to see a high return expectation as well. So to take an opportunity to an investor which nets them maybe a 30% or a 40% IRR, that really is not a VC opportunity. It should be something which makes it a multi-bagger for them, and that is when they will really show interest. Once I cross the VC stage, and VC typically would be anywhere from $1 million to $10 million, and sometimes VCs are also the first institutional investors in companies. So once I go past proof of concept, I am stable as a business. My mortality risk is far lower than what it used to be. And I'm really looking at capital for growth, for really taking my business model, which is proven, and for replicating it or moving it geographically or entering into new product lines. That is where growth stage investors, typically called as private equity investors, will step in. So as compared to a VC investor, a PE investor does not have the same risk tolerance. They are far more conservative, which is why they invest at a far later stage in the company's life cycle. At the same time, their return expectation is also not going to be as high. So anywhere from a 25 to 28% IRR would be a very good return for a private equity investor. So they will probably have a portfolio of 8 to 10 to 15 companies. They cannot tolerate mortality, so it will be a very bad outcome if they are not able to get at least their capital back from all their investments. And on the other end of the spectrum, they are not expecting a multi-bagger. If they make a 35 to 40% return, that's a very, very good outcome for them. So they have a mixed bag across their portfolio, and ultimately their aim is to deliver something like a 25% IRR to their investors. So that's how a private equity fund differentiates from a VC fund. As you scale, you get into late stage private equity as well, characterized by larger check sizes, and with a real call which the investor is taking that this company in the next 1 to 2 years will eventually go for an IPO. So return expectation will be lower, but stage in the life cycle will be fairly late stage. You're looking at almost a pre-IPO company. If things go well, then post that, if public markets are good, the company can go for an IPO, get access to a far deeper pool of institutional retail investors. Or the other options could be to go for a buyout fund. So as compared to the other investors who typically take minority stakes, a buyout fund will take a controlling stake into companies. They will typically give exit to all the investors in the company and partially to the founder as well. And they actually have the potential and they have the capabilities to hire a management team to actually run the company in case they find a promoter who wants to exit. and they will typically work with the company and ensure that it sort of scales well for the next maybe 1, 2, 3 years until the point of time where an IPO can potentially happen. Now, if things don't go out well, even post that, the company, let's say, falls into distress. There is a category of funds which are turnaround capital or distress stage investors who take over stake from other investors or from the founder at a lower valuation, potentially maybe giving others a haircut as well. But specialists in terms of turning around situations, helping companies back into profitability, stabilizing them, sustaining them, and eventually taking them for an exit at a later point of time. This is not a very common sort of setup or a common sort of set of investors in India, but it's a very, very sort of vibrant market internationally.